Do you ever wonder what is the difference between a mutual fund, an index fund, an ETF, or stocks or bonds? That is what we are going to talk about today. Hey everyone, thank you for watching Casual Finance. In my last video, I mentioned that once you actually transfer the money into your Roth IRA or any investment account for that matter, you actually have to invest it. So what are the things you can actually invest in a stock market? So broadly speaking, for beginners, there are only four things. So stocks, bonds, mutual funds, and ETF. You may notice that I didn't mention index fund because they are like a subcategory of mutual funds. So let's break them down. Number one, stocks. Stocks are basically pieces of ownership in a company. When you buy a stock or a share, you are basically buying a slice of the business. If the company performs better, you get the return on your investment. The downside risk is if the company goes down or performs poorly, your investment also diminishes in value. Number two, bonds. Bonds are basically loans, but you are the lender. So when you buy a bond, you lend your money to another company or government, and in return, they promise to pay your money back with some interest. Bonds are generally safer than stocks, but the trade-off is their returns are very low. It's not exciting as stocks. Think of them as the steady, reliable part of your portfolio, and stocks are excitement and growth. Number three, mutual funds. They are the answer to the question, can I have both growth and stability? These funds are a basket of funds. Instead of picking and choosing stocks and bonds, you buy one fund and the fund will invest in a variety of stocks and bonds, and you will get a stable growth and good returns, and generally considered a safer investment choice. The primary difference between mutual funds and index funds is how they are managed. Mutual funds are managed by professionals, so you don't have to worry about picking the funds. The downside is that they cost a little bit more and humans can make mistakes. An index fund, on the other hand, tracks the whole market or a segment of the market, so there is no risk involved and they are typically lower in fees compared with mutual funds. When the market goes up, your fund goes up. Number four, ETF. ETF stands for Exchange Traded Funds. They are very similar to mutual funds and index funds. Again, the difference is how they are traded. When you buy a mutual fund or an index fund, they are typically executed or traded at the end of the business day or the market day. But ETF are like stocks, so you can buy and sell them anytime when the market is open. ETF is a relatively new product compared with mutual funds, but they are very flexible and you can almost find an ETF for any theme that you like. You can buy a technology ETF, healthcare ETF, utility ETF, even Bitcoin, gold, etc. That sums it up. Those are the four basic type of investment you can make with your account. But what is the best? That is very subjective and varies person to person. But I can tell you what are my favorite investments to make. Like and follow for simple, no BS personal finance stuff, and I will see you in the next one.